Look, let me describe a scene. It's a Monday morning. You open your phone. Markets are red. Again, your portfolio is down 28%. The stock you were very confident about is now making you feel stupid. WhatsApp groups are silent. News anchors are shouting words like crisis, global sell off, uncertainty. You tell yourself, let me just exit. I'll re enter when things stabilize. You sell. 2 months later, markets bounce back. Your stock is up 40%. And you're sitting there thinking, how did I manage to sell at the exact bottom? If that has ever happened to you, this video is about you. Because here's the brutal truth. Indians don't sell at the bottom because they lack information. They sell because their brain is wired to betray them. Most people think bad investing decisions come from lack of knowledge, bad stock selection, not watching enough YouTube videos. That's nonsense. Here's what most people don't realize. Your biggest enemy in the market is not volatility, it's your own nervous system. And today, I'll show you why Indians panic sell more than most global investors, the exact psychological trap that forces selling at bottoms, why this happens even to experienced investors, and most importantly, how to stop doing it permanently. This is not motivational gyan. This is behavioral finance Indian style. Let's start with the number. According to multiple studies globally, including Dalba's long-term investor behavior studies, the average equity investor earns 3 to 5% less than the market return. Not because markets are rigged, but because investors buy late, sell early, panic at the worst possible moments. Now bring this into India. Between 2013 and 2023, Nifty 50 delivered roughly 12 to 13% CAGR. Average Indian equity mutual fund investor earned closer to 7 to 8%. That gap? That's not fund manager failure. That gap is human behavior. Same funds, same market, different outcome. Why? Because investors exit when fear peaks, not when logic says so. Let's talk about why fear peaks exactly at market bottoms. Because it's not random, it's structural. Reason number 1, loss aversion. Your brain hates loss more than it loves gain. Here's a simple truth. Psychologists have proven that losing 1 rupee hurts about twice as much as gaining 1 rupee feels good. Read that again. Your brain experiences losses 2 times more intensely than gains. So when your portfolio falls, logic says nothing has changed in the business. Brain says stop the pain. Selling feels like relief, even if it's financially stupid. That relief is addictive, so you sell, not to make money, but to stop emotional discomfort. Imagine this. You invest 10 lakh rupees in the market. Market crashes 30%. Your portfolio is now 7 lakh rupees. Now here's what your brain focuses on. I have lost 3 lakh rupees. Not I still own the same businesses. Not markets have always recovered. Your brain screams save what's left. So you sell. But here's the math no one shows you. If that 7 lakh rupees recovers back to 10 lakh rupees, you didn't gain 30%. You gained 42.8%, which means maximum upside appears after maximum fear. And that's exactly when people exit. Now you might be thinking, okay, but everyone panics. What's special about Indians? Good question. Here's the uncomfortable answer. Reason number 2, Indian money is emotionally overloaded. For most Indian investors, money is family security. Money is social status. Money is survival. In India, money isn't abstract. It's parent sacrifices, EMIs, children's education, marriage expenses. So when markets fall, it doesn't feel like temporary volatility. It feels like my family's future is at risk. That emotional load amplifies panic. Western investors often invest surplus money. Indians invest emotionally tagged money. That changes everything. Here's another psychological landmine. Humans are herd animals. When markets crash, everyone around you is panicking. News confirms your fear. Family members ask, "You sold, right?" This creates social proof pressure. Selling feels responsible. Holding feels reckless. Here's what most people don't realize. At market bottoms, selling is socially rewarded but financially punished. And holding is socially punished but financially rewarded. Most people choose social comfort over financial outcomes. Here's something that shocks people. Even investors with 10 to 15 years of experience panic sell. Why? Because experience doesn't override biology. Your brain evolved to avoid danger, preserve resources, react fast, not think deeply. Markets exploit that wiring. Rakesh Jhunjhunwala understood this deeply. He once said, in essence, markets exist to transfer money from the active to the patient, not the smart, not the informed, the patient. Now you might be thinking, I'll sell now and buy back later at a better price. Sounds smart, feels smart, but let's destroy this illusion with math. Let's say you invested 10 lakh rupees in the market. Over 20 years, market returns approximately 12% CAGR. Your money becomes approximately 96 lakh rupees. Now let's say you miss just the 10 best days in those 20 years. Your return drops by nearly 50%. Miss the 20 best days? Your long-term return becomes close to fixed deposit levels. Here's the punchline. Most of the best days come right after the worst days. You sell during the worst days. You miss the recovery. You lock in mediocrity. This is not theory. This happens every cycle. The market doesn't punish ignorance. It punishes emotional reaction. Most Indians enter markets emotionally, exit markets emotionally, then blame luck, timing, or manipulation. But the real problem is internal. Here's the core reason people sell at the bottom. They confuse volatility with permanent loss. Volatility is temporary. Business destruction is permanent. Most market crashes are volatility events, but your brain treats them like extinction events. So it chooses safety at the worst moment. So how did Jhunjhunwala avoid this? Simple. He separated price from value, noise from reality, emotion from action. He didn't ask, is the stock down? He asked, is the business broken? If the answer was no, he did nothing. Sometimes he bought more. Let's get practical. Here's what you can do starting immediately. Step 1. Decide your exit rules before you invest. Never decide exits during panic. Write this down. I will sell only if the business thesis breaks. Not because price fell, because news is bad, because relatives are scared. Step 2. Invest only money you can emotionally handle losing temporarily. If a 30% fall causes panic, you're overexposed. Reduce position size. Not because markets are risky, but because your emotions are. Step 3. Stop checking your portfolio daily. Daily checking increases emotional volatility. Long-term investing requires less information, more discipline. Ignorance is sometimes an advantage. Step 4. Expect crashes, mentally and financially. Market crashes are not bugs, they are features. If you expect them, you won't panic, you won't feel betrayed, you'll act rationally. Markets don't reward intelligence, they reward emotional control. Most Indians sell at the bottom not because they are wrong, but because they are human. Your job as an investor is not to predict markets, it's to outlast your own fear. So next time markets crash and your hands start shaking, pause. Ask yourself, has the business changed or has my emotion changed? Because if you master this one thing, you'll already be ahead of 90% of investors. Now tell me in the comments, what was the worst panic sell you ever made? Let's talk about it, and this time, learn from it.